Ever feel like you're stuck on that financial hamster wheel?
Yeah.
Like you're saving, you're working hard, but real wealth just feels so far off.
That's a common feeling, yeah.
It is. It is. And that's actually what we're diving into today. You sent in this article about saving, and it really got me thinking. It talks about how saving is important, sure, but it's not the whole story.
Yeah, and it's interesting, right? We're always told to save, but no one really teaches us how to make that money grow.
Exactly. It's like saving is the foundation. But to build a house, you need the walls, you need the roof, you need the whole thing. So this article talks about how traditional savings accounts, even those high-yield ones, they don't really keep up with inflation.
That's right. It's almost like you're running on a treadmill. You're putting in the effort, but you're not really getting anywhere.
It's a sneaky way to lose ground without even realizing it.
Yeah. Like if inflation is at 3% and your savings are only giving you 1%, well, you're actually losing purchasing power. That $1,000 you put away is only worth like $970 after a year.
Oof, not very motivating.
No, not at all.
So we're seeing that saving alone just isn't enough. And this article really emphasizes investing, but that word investing can feel kind of scary, you know?
I totally get that. There's definitely risk involved. That's why it's important to know how much risk you're comfortable with. It's not one size fits all.
Right, right.
But history shows us that stocks, mutual funds, real estate, they've done much better than savings accounts over time. It's about putting your money to work, not letting it just sit there.
Okay, so how do you actually pick what to invest in? I mean, the article mentioned factor investing, which sounds cool but complicated.
Factor investing is really interesting. It's about targeting specific things about companies or assets that have historically led to better returns.
So instead of picking individual stocks.
Exactly. You're identifying these underlying factors, like maybe a company has low volatility or really high growth potential. Things that tend to do well over time. It's a more systematic approach.
So it's about understanding the engine that makes things go, not just picking a car at random.
That's a great way to put it. And this ties in with another important idea from the article. Diversification. It's like the old saying, don't put all your eggs in one basket, but for your investments.
So building a house with lots of different materials instead of just one so it can stand up to anything.
Exactly. You want a strong, balanced house, and diversification does that for your investments.
Makes sense. But there's stocks, bonds, real estate, even things like cryptocurrency. It's a lot to think about. How do you even create that balanced portfolio? One that's right for you.
That's where understanding asset classes and how they relate to each other comes in. Stocks, they tend to be riskier, but they can also grow a lot faster. Bonds are usually more stable, but they grow slower. Real estate, great long-term investment, but not as easy to access quickly.
Gotcha. So someone younger, they might want more stocks for that growth, but someone closer to retirement, maybe more bonds for stability.
That's a good way to think about it. It's all about finding that balance between risk and reward. What makes sense for you, your life, and your goals.
Okay, so we're getting into the nitty-gritty of investing here, which is super helpful. But this article also dives into psychology, right? How our emotions can actually mess with our financial decisions. That's behavioral economics. And I got to say, I'm really curious about that.
Oh, it's a fascinating field. Turns out our brains aren't always logical, especially when it comes to money. We've got these built-in biases that can really trip us up.
Oh, I can relate to that.
The article mentions loss aversion. It's basically the idea that losing $100 hurts way more than gaining $100 feels good.
So that explains why it's so hard to sell those investments that are doing poorly. It feels worse to cut your losses than it does to potentially miss out on a gain.
Exactly. And logically, it doesn't always make sense.
So how do you fight that? Just got to be super disciplined and ignore your gut feeling.
Well, the first step is just being aware of it. Knowing about the bias helps you spot it when it pops up.
Okay, yeah, that makes sense.
One strategy is to kind of reframe your thinking. So instead of focusing on that potential loss, think about the potential gain if things go right. Shift from that fear to looking at the opportunity.
That's a powerful shift. But those gut feelings are strong. Any other ways to deal with that loss aversion?
You can set up something called a stop loss order. It's basically a price you set beforehand. If your investment drops to that price, it automatically sells.
Oh, that's smart. So you're taking the emotion out of it. No more agonizing over whether to sell or not.
Exactly. It's like a safety net.
This is making so much sense. But behavioral economics seems like it's full of these sneaky little biases that can get us. Any others we should be on the lookout for?
Well, the article also talked about something called mental accounting. It's the idea that we categorize money differently in our minds depending on where it came from or what we plan to use it for. Like, we treat a bonus different from our regular paycheck.
Oh, I'm so guilty of that. If I get a tax refund, suddenly it's like free money, even though it was mine all along.
That's exactly it. And that can lead to problems with saving and spending. We're more likely to spend money labeled fun money than money for bills, even if it's all coming from the same account.
It's like our brains have these invisible compartments for money, and we treat each one totally different.
That's a great way to put it. And it can lead us to make choices that don't really make sense, like being reluctant to use your emergency fund to pay off high-interest credit card debt, even though logically that's the smarter move.
It's like we're learning a whole new language here. Personal finance isn't just about the numbers. It's about understanding how our brains work, too.
I completely agree. And that awareness can really help us make smarter financial decisions.
Okay, so we've covered a lot of ground. Saving, investing, behavioral economics. But let's bring it back to the real world. The article talked about a case study with a couple saving for their daughter's education, right? I'd love to hear more about that.
Sure. So Dean and Jenny, they wanted to pay for their daughter Alice to go to private high school, which they figured would cost about $84,000, factoring in today's costs.
Wow, that's big goal. Did they just try to save every penny they could?
They were smarter than that. They saved some and invested some. They started with a $5,000 investment and committed to saving $460 every month.
That's a good chunk of change every month. But did they consider things like inflation and how much their investments might grow?
They were really thoughtful about it. They figured they'd get a return of about 7.7% on their investments and made sure their monthly savings kept up with inflation. Their plan was all set up to reach that $86,000 goal by the time Alice was ready for high school.
That's impressive. They weren't just crossing their fingers and hoping for the best. It sounds like a calculated risk, but a smart one.
Exactly. They knew saving alone wouldn't cut it, especially with education costs always going up. They needed that boost from investments to reach their goal.
It's inspiring to see how with some planning and discipline, even big financial goals are possible. And it really shows why starting early is so powerful, right? More time for those investments to grow.
Oh, absolutely. It's like that saying, the best time to plant a tree was 20 years ago. The second best time is today. Even small amounts, invested consistently, can grow a lot thanks to compounding.
Speaking of compounding, can we break that down a bit? What is it exactly and how does it actually work?
Imagine a snowball rolling down a hill. It starts small, but picks up more snow as it goes, getting bigger and bigger.
So it's like your money's making more money, which then makes even more money. I'm starting to see why they call it magic.
Precisely. And the longer you let it roll, the more powerful the effect. That's why starting early and investing consistently makes such a big difference.
Okay, that's starting to click. But we've also been talking about risk. How do you balance getting those returns with managing the risk? Is there like a formula?
It's not exactly a science, but there are some good rules of thumb. Diversification, like we talked about before, is key. By spreading your money across different things, stocks, bonds, real estate, you're basically lowering your risk.
So if one investment takes a hit, hopefully another one is doing well, and overall, your portfolio stays more stable.
Exactly. It's like having a diverse team. If one player has a bad game, others can step up.
Makes sense. And I'm guessing how much risk you're comfortable with also plays a big role. Someone younger, further from retirement, might take on more risk than someone closer to retirement who wants to play it safer.
Absolutely. It's about finding that sweet spot, risk versus reward, and what lines up with your own life and goals.
This is all coming together. But investing still feels kind of mysterious and overwhelming. Where do you even begin?
The good news is there are tons of resources out there. Books, articles, financial advisors, even online courses.
So don't just jump in blindly. Do your research first.
Exactly. And remember, investing is a marathon, not a sprint. Make smart choices, stick with it, and adjust along the way as you learn more.
This is a great reminder. It's not about getting rich quick. It's about building that foundation for a strong financial future.
I couldn't agree more. And speaking of foundations, let's circle back to saving for a second.
Right. The foundation of our metaphorical house. We talk about the downsides of saving, but it's still crucial, right?
Absolutely. It's a vital part of any good financial plan.
So how do we balance saving for the short term with investing for the long term? That's something I've always struggled with.
It's a common question. Ideally, your financial strategy should have a mix of both. Savings act as your safety net, the money you can access quickly, while your investments are working towards those bigger long-term goals, like retirement or buying a home.
So I need to be strategic about how I use my money. Short-term needs, versus long-term goals.
Ooh.
But how much should I actually be saving? Is there a magic number or percentage?
Well, it depends on your income, your expenses, and what you're aiming for. But a lot of people use the 50-30-20 rule.
Oh yeah, I've heard of that. Can you refresh my memory on what that is?
It's pretty straightforward. You take your take-home pay, and 50% goes to your needs, 30% to your wants, and 20% to savings and paying down debt.
Okay, that's a good starting point. But sticking to a budget is tough. Life always seems to throw unexpected expenses my way.
Yeah, I hear ya. That's where budgeting apps can be really helpful. They keep track of your spending, help you see where you can cut back, and some can even automate your savings.
So it's like having a personal finance assistant right in your pocket. But there are so many apps out there. Do you have any favorites?
It really depends what you need and what you like. But some popular ones are Mint, Wine Abbey, and Personal Capital. They all do things a little differently, so it's good to try a few and see what fits you best.
I'll have to check those out. This is great. It's like we're putting together a whole toolkit for managing money. But beyond budgeting and investing, the article talked about something else. Diversifying income streams. Why is that important?
Having different income streams can give you more financial security and help you reach your goals faster. It's about having multiple ways to earn money, not just relying on one job.
So it's like having multiple rivers flowing into your financial lake,
Yeah,
making it bigger and more resilient.
that's a great way to think about it. This could be things like side hustles, freelance work, or even passive income, like rental properties or investments that pay you dividends.
And how does this tie into saving and investing?
Well, the more money you're bringing in, the more you can save and invest. So it's like giving yourself a head start.
This has been so insightful. We started feeling a little overwhelmed by all this financial stuff, but now we're talking about practical things we can do to build wealth and reach our goals.
I'm glad to hear that. And remember, it all starts with understanding the basics, how saving works, how investing works, and how to make your money work for you.
Right. And understanding those tricky mental biases that can get in our way. But before we wrap up this part, the article emphasized financial literacy. Why is that so important for being good with money?
Financial literacy is all about having the knowledge to make smart decisions with your money, understanding things like budgeting, saving, investing, and how debt works.
So it's not just about knowing how much you have, but actually knowing how to use it well.
Exactly. It gives you the tools to avoid common mistakes and reach those financial goals.
So how do we get better at this whole financial literacy thing? Where do we even start?
There are so many resources out there, both online and offline. You can read books and articles, attend workshops, or talk to a financial advisor.
And don't forget about learning from everyday life. Pay attention to the financial news. Ask questions. Talk to people you trust about money.
Absolutely. The more you engage with financial information, the more confident you'll become managing your own money.
This has really changed how I think about saving. It's not just putting money aside, it's building a foundation for the future.
That's a great takeaway. Saving is important, but it's just the beginning. By combining saving with investing, diversifying your income, and learning more about finance, you can create a more secure and prosperous future.
It's a journey, not a race. Celebrate those wins, learn from your mistakes, and keep moving forward.
Well said.
Now, this article had a thought-provoking question, one that I think is perfect to end this part of our dive with. It asked, if you could create your perfect financial future, what would it look like?
That's a great question. It really makes you think about what matters most, doesn't it? What does financial freedom truly mean to you?
Ooh, that's a tough one to answer. I mean, there's a lot of things I'm passionate about. I've always loved learning new things, and then sharing that knowledge with other people. Maybe I'd start a podcast or create like online courses. Oh, wait a minute. Isn't it kind of what we're already doing here?
You got me there. But really, it's great to see you chasing your passions. It shows that anyone can turn their interests into ways to make money. It just takes a little creativity.
So true. You got to figure out your strengths and find ways to use them. And speaking of using what we've learned, this whole deep dive has been a game changer for my own understanding of finances. It's like we've been peeling back the layers of a really complex onion. So many hidden insights and strategies. But there's one more layer I want to dig into, the whole behavioral economics thing. How our emotions mess with our money choices.
It's a fascinating field. Knowing how our emotions and biases affect our decisions can be super powerful. It's like shining a light on those little subconscious things that trip us up.
Exactly. Like we talked about loss aversion, but the article also mentioned something called anchoring. Can you explain what that is and how it affects our money decisions?
So anchoring is basically this tendency to fixate on the first piece of information we get, even if it's not even relevant or accurate. It's like our brains latch onto that first number and use it as a reference point for everything else.
So even if the current's pulling you in a different direction, you're still kind of stuck on that initial anchor point.
Yeah, like imagine you're buying a new TV. The salesperson shows you this super fancy model that's like $3,000. Then they show you a decent mid-range model for $1,500. Even if that $1,500 is a fair price, it seems like a steal because you're comparing it to that $3,000.
Bro, that's sneaky. Like setting a high bar so everything else looks good in comparison.
Exactly. And it happens with investing too. If you hear a stock is worth $100 a share, you might be hesitant to buy it even if it drops to $50 because you're anchored to that initial price.
So you might miss out on a good deal just because you're stuck on that first number.
That's right.
So how do you fight these anchoring biases? Is it even possible to overcome them?
Like most biases, awareness is the first step. Just knowing about it can help you see when it's happening. Question those initial anchors. Are they really relevant? Are they based on solid information? Or are they just there to influence you?
So be a little more critical of the information you're given. Don't just take it at face value.
Exactly. And there are things you can do to counter it. Instead of focusing on that first price, try to figure out the real value. Look at similar things, compare, do your research. Don't be afraid to walk away if something seems overpriced, even if it's much lower than that initial anchor.
That's a good point. You got to do your homework and not let those initial impressions cloud your judgment.
What about loss aversion, though? We talked about reframing our thinking and using those stop-loss orders. Anything else to help overcome that fear of losing money?
One thing that helps is focusing on the long game. Loss aversion is stronger in the short term. We feel that pain of a loss more intensely right away. But if you zoom out, look at the bigger picture, those daily ups and downs don't seem so important.
Right. It's like zooming out on a stock chart. Up close, it's all over the place. But from a distance, you see the overall trend.
Exactly. Focus on your long-term goals, and you can ride out those short-term bumps and make better decisions. This whole behavioral economics thing is so interesting. It's like a secret code to understanding our financial choices. It's empowering to know that we're not just slaves to our emotions. We can actually find ways to manage them.
Couldn't agree more. It's about taking control of those decisions and making sure they line up with what you want in life.
Speaking of what you want, the article mentioned some pretty amazing success stories of people who built wealth through smart planning and investing. Can you tell us about some of them?
Sure. A classic example is Warren Buffett. He's often considered one of the best investors ever. He's all about value investing, finding those companies that are undervalued but have potential for long-term growth. And it's worked incredibly well for him.
It's like a reminder that patience is key. But not everyone can be Warren Buffett, right?
Yeah.
What can regular people learn from these super successful investors?
The big takeaway is that understanding how money works, being willing to learn, and having discipline with saving, investing, and managing risk, that's what leads to success.
So it's about taking those core principles that worked for them and applying them to our own lives, even if our goals are different.
Exactly. And remember, success doesn't happen overnight. It takes time, persistence, and learning from both your wins and your losses.
This has been so inspiring. We've talked about so much, from saving to investing, diversifying income, and even those sneaky psychological biases.
I agree. It's been great discussing these ideas with you. Just remember, building wealth is a journey. It takes a combination of approaches and a commitment to keep learning.
Before we wrap up this part, I'm going to say this. Financial success is possible for everyone. It doesn't matter if you're just starting out or looking to improve what you're already doing. The key is to take action, make smart choices, and never stop learning.
Well said. And remember, it's never too late to begin. Every step you take towards financial well-being is a step in the right direction.
Now, for a final thought to leave you with as we move to the next part of our dive, if you could design the perfect financial future, what would it look like?
That's a great question to think about. It makes you consider what you truly value and what you want your money to do for you. What does real financial freedom mean to you?
It really does make you think, It's not just about like random numbers. It's about what those numbers actually mean for your life. What does it actually mean to be financially free?
And that's going to be different for everyone, right? For some folks, maybe it's early retirement, traveling the world, finally getting to focus on those hobbies they love. For others, it might be knowing their family is taken care of no matter what, or having enough to give back to their community. There's no one right answer.
It's about figuring out what matters most to you and making sure your money helps you get there. So if you're really into like environmental stuff, maybe your ideal financial future is investing in green tech or even starting a business that helps the environment.
Exactly. You want your money to support those core values. And the cool thing is this vision can change over time, Your priorities might shift, things happen in life. It's all about having that guiding vision to keep you motivated.
I like that guiding vision thing. So it's not about being super rigid with your plans. It's about having a direction, knowing why you're making the financial choices you make. And that brings us back to taking action, right? It's not enough to just dream about it. You got to actually do something.
Absolutely. Dreaming is great, but you need a plan. Once you have that clear vision, you can work backwards. Think about those milestones, the habits you need to build, the skills you need to learn. Break it down into smaller steps that you can actually tackle.
And those steps could be things we've talked about already, like saving consistently, investing smartly, figuring out ways to earn more income, and of course, mastering those tricky mental biases that can trip us up.
All of that. It's about understanding how all these pieces fit together. And it's important to remember this is a marathon, not a sprint. There will be bumps in the road, challenges will come up, but keep your eye on that long-term goal, learn as you go, and don't give up.
So true. This has been an incredibly eye-opening conversation. We've covered so much, and I feel like I'm walking away with a whole new perspective on managing my money.
Me too. It's been great chatting with you.
Before we sign off, I just want to emphasize this. Financial success is possible for everyone. It doesn't matter where you're starting from. The key is to take those first steps, make good choices, and keep learning.
Couldn't agree more. Every step towards financial well-being is a step in the right direction.
And to wrap up our deep dive today, I'm going to leave you with one last thought. Take some time to really picture your ideal financial future. What does it look like? How does it make you feel? And what's one small step you can take today to start making that vision a reality?
That's a powerful exercise. And remember, even those small steps can add up to big changes over time. The most important thing is to start, to keep learning, and to never stop believing in your ability to create the financial future you want. Thanks for joining us on this journey.
We'll be back next week with another deep dive. But until then, keep exploring and keep striving for financial well-being.